everyone. Welcome to the A-Level Business Studies class. Today we're going to discuss the topic External Economic Influences on Business Activity. In this lesson, we're going to cover different objectives of the government and how these macroeconomic objectives affect the growth and the working of a business firm. We will also look at how the state might intervene to help businesses. How does the state intervene to constrain businesses big and small? We're going to discuss the key macroeconomic objectives of the governments, which include inflation, unemployment and economic growth, and the impact that they have on business activity. Last but not the least, we will also discuss how changes in macroeconomic performance and policies may affect business behavior. So let's start with the macroeconomic objectives of the government. There are 6 of them. The first one being economic growth, followed by low price inflation. They also aim to cater to low rate of unemployment, a long-term balance of payments, exchange rate stability, and last but not the least, wealth and income transfers to reduce inequalities among the people. Let's first understand what is economic growth. Economic growth is an increase in the amount of goods and services produced per head of the population over a period of time. An increase in the country's production potential measured in terms of the country's real GDP. Now the point comes, what is GDP? Known as Gross Domestic Product, this is the total value of the goods and services produced in a country in 1 year. When this value is adjusted to account for the inflation that has happened over 1 year, it is known as real GDP. Else, when it's not adjusted for inflation, it is known as the nominal GDP. Why is economic growth important is a question that arises. Why does every government, every economy want to grow? There are multiple advantages that lead to economic growth being important. Firstly, it increases the standard of living of the people of the country. It definitely provides higher employment rates. It reduces absolute poverty. Understanding what is absolute poverty? Absolute poverty is when people are really poor. And the other term that comes here into existence is relative poverty, when you compare yourself with a person and you term yourself as poor compared to the other one. So economic growth focuses on absolute poverty. There are rising demands for products, which increases the economic growth. There is more revenue for the government due to higher taxes being paid because people are earning more. And there is higher public sector investment without reduction in other sectors, which helps the economy to grow. So if the government were to invest more in education and health facilities, it definitely helps the economy grow. What are the causes of economic growth? 3 simple causes. Technological innovation, increase in economic resources, that's the factors of production, and increase in productivity. Technological innovation. This is when businesses invest. So business investment leads to technological innovation. They want to find out new ways and new mediums of producing and marketing things, which leads to higher business investment. This is expenditure which a business will do on capital equipment, new technology and research and development, which definitely helps a business grow. With these 3 things that lead to economic growth, the business cycle gets affected. What is business cycle? The term business cycle, or also known as economic cycle or the boom-bust cycle, it refers to the economy-wide fluctuations that happen in production, in trade and general economic activity. Let's look at a conceptual perspective for this. The business cycle is the upward and downward movements of the levels of GDP, that's the gross domestic product, and refers to the period of expansions and contractions in the level of the economic activities around a long-term growth trend. There are 4 stages of a business cycle. They have expansion, a boom period, a recession period, and a depression period. Let's understand these 4 different phases of a business cycle. Business cycles are identified as having 4 distinct phases, starting from expansion to a peak, also known as boom, to a contraction, known as a recession, and a trough, known as a depression. An expansion is characterized by increasing employment, economic growth, and upward pressure on prices. A peak is realized when the economy is producing at its maximum allowable output, employment that is above the full level of employment that it could be, close to full employment, and inflationary pressures on prices are evident. Following the peak, an economy typically enters into a correction phase which is characterized by a contraction where the growth will slow down, the employment will decline a little, so unemployment increases and pricing pressures will subside. The slowing cases, it has to stop at the trough phase of the economy, and at this point the economy has hit a bottom from which the next phase of expansion and contraction will emerge. So it's a cycle, and that's why expansion, boom, depression follows and is again taken up from where the cycle keeps moving around and helps for the economy to stabilize and grow at the same time. Let's understand what is recession. A constant decline in the real GDP over a period of time, let's say 6 months or more, is known as recession. Now, recession can also be helpful to an economy. And how? The capital assets become cheaper. So, yes, it will lead to more capital investment into businesses. The demand of inferior goods go higher. Yes, the demand of inferior goods will again lead to increase in demand. Risk of job losses might lead to improved relationship between employee and employers, which will definitely benefit the company and the business at large. And economic restructuring might happen, which will lead to higher economic development and higher economic growth. Inflation, a very broad term. This term inflation is basically defined as a sustained increase in the general level of prices for goods and services, measured as an annual percentage increase. So over a period of a year, we would see how much of inflation has taken place in an economy. As inflation rises, every dollar you buy now, or every rupee you own, or every dollar you own now, buys a smaller percentage of a good or a service. The value of the dollar or the rupee does not stay constant when there is inflation. Let's understand what is deflation. So if inflation was a sustained increase, deflation is going to be a general decline in prices. This is often caused by the reduction in the supply of money or credit. Deflation can be caused also by a decrease in the government, personal or investment spending. The opposite of inflation, deflation has the strongest side effect of increased unemployment, since there is a lower level of demand in the economy, which can lead to economic depression, which if continued will be harmful to the economy. Central banks definitely attempt to stop severe deflation along with severe inflation in an attempt to keep the excessive drop to a minimum. So a balance of inflation and deflation is what the economy and the government tries to aim at. Now, how does one measure inflation? Inflation is measured through CPI, which is the Consumer Price Index. Every month, the prices of approximately 6,000 daily goods and services are measured, and they are compared with the price of the base year. The base year generally would be the last year that we would take. These increase in the price as compared to the base year gives a measure to inflation. Causes of inflation. There are two causes of inflation. One, the cost push inflation, and the second being the demand pull inflation. What is cost push inflation? Sometimes domestic products become expensive because there is unavailability or higher demand for the goods. Sometimes the imports of raw materials become expensive because worldwide prices have increased. In such a scenario, the business aims at keeping their profit margins constant. And when the cost of production increases and the profit margin has to be kept constant, the only option left is to increase the selling prices, which is known as cost push inflation. Inflation which is achieved, or inflation which is a result of the increase in the cost of raw materials, goods, services, basically the cost of production. The second one is the demand pull inflation. Inflation may also occur due to the higher increase of demand of goods in the market. This could be due to multiple factors, maybe people having a better standard of living and demanding more goods, the country exporting more goods, or worldwide demand of the product increasing. These are the two causes of inflation, one related to cost and the other related to demand. We will now understand the further effects of inflation and how inflation can be changed and impact in the next class or in the next module that is going to come up soon. Thank you.